Ladies and gents, traders and investors, a very warm welcome to our channel Polo Vehicle. On today's video presentation, we shall talk about broken wing butterfly spreads or the asymmetric butterfly spreads. As the name suggests, in these kind of butterfly spreads, the wings are asymmetrical about the center strike prices or the center strike price. What we do is we try to finance the debit spread with the credit spread that we get into, and thus the upfront cost is zero, or there is a profit while we get into the trade, but the actual profit from the broken wing butterfly trade occurs from the directional movement of the long that we get into, because of the reason that the credit spread is very small. It cannot be the reason for getting into the trade. The trade works in our favor once we've reached the 50% value or slightly higher towards the target, and then we try to reassess our position to see if we can continue to be in the trade or should we get out with the profit received. Over and above the broken butterfly spreads, we shall also be touching upon the events from the week and shall be visiting the charts of US dollar index, which is the Dixie, NQ, the Nasdaq based ETF, S&P 500 based ETF, which is ES, XAU/USD, which is the gold based ETF, XAG/USD, which is the silver based ETF, and US oil spot, which has seen a remarkable rise in price during this week because of the escalation of the war between Iran and United States of America. Disclaimer/disclosure. The contents of the presentation are for information purposes only. The material is obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 51st of a series of interactive videos aimed at educating our viewers, and we'd like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment and trading is a highly risky business, and there exists a possibility of partial or total loss of investment. The ideas and opinions in our video are solely based on our analysis of the market, and we do not advise, recommend, guide anyone to take any trade based on the contents of this video. We do not take any responsibility for partial/total losses arising out of trades based on the contents of our video. The chart on our screen is that of US oil spot, and we're looking at the daily chart. US oil has been going up and down under the influence of news coming out of the war between United States of America and Iran. Ever since the closure of the Strait of Hormuz, it went down all the way from 114.96 to 75.75 on the commencement of the war between the two nations. And then with the release of news every singular day, it started moving sideways until the peace deal was signed, and then it went back down after stopping for a bit at the demand zone between 75.5 and 72.8 to briefly stall for a moment and then go back down to the next demand zone between 67 and 63.25. Once the war has resumed, it has gone back up again, and it has found a bit of resistance at 75, which was a support area once upon a time, and then after dropping down to 71.2. It has resumed its travel upwards again, and then we can expect it to stall at the new supply zone between 86.8 and 94.1, which seems to have a lot of sell orders left behind, and one needs to wait and see if it can turn around from here or it consumes all the orders and then moves back up again. However, if it returns from this particular zone, then as of now we've got a nice area to go long where we can find a bounce, and then we can go long as it moves towards the next supply zone in the opposite direction, or if it breaks down, then we can find another demand zone at 71.15 and 72.5. These zones can give us a bit of bounce, but we need to be careful with the news coming out every now and then, and must keep our stop losses absolutely tight and close to the boundary of the demand zones that we are going to enter in. But the best trade would be to wait and see if it turns around from the new supply area above, and then try to go short at the newly formed supply zone. Traders and investors, the chart on our screen is of Dixie, the US dollar index, and we're looking at the daily chart. Dixie has managed to recover all its losses from the week when it came down under the influence of news related to the Fed announcement. But then once the war resumed, Dixie has managed to gather some strength. However, it's still hovering around its range that was about 100.391, where it had been stuck for a very long time, and it's still now the resistance which has turned into support, and that's how it's trying to bounce off this area and go back into the supply right on top of it between 101.077 and 101.887. However, we need to wait and see if there is an additional strength injected into the US dollar index by the ongoing war between United States of America and Iran, and the increase in prices of oil that could help the dollar regain some of its lost strength and go past the supply area between 101.077 and 101.887. But as of now, it's just hovering around its old resistance that has turned into support, and one needs to stay away from the index for a while until we know the direction has been established, whether it goes back into its old range between 95.45 and 100.391, or whether it goes up above the new supply area that we've just talked about. The chart on our screen is that of NQ, the Nasdaq based ETF, and we're looking at the daily chart. NQ had been going sideways the entire week until it decided to drop below its range and come into the old established demand zone, which has been retested for the second time. This zone is between 28501 and 27995. One needs to wait and watch if the bounce is going to take it back to the supply area at around 29673, and the stop loss being above 30065. This area will have a lot of sell orders waiting for the rally to come back into this zone, and the bears could take a bit of profit all the way down to the same 28501 area. But it still needs to be seen if it continues its bearish move downwards and takes out all the buy orders in the demand zone, or whether it bounces back up and goes into this supply area. So as of now, one can expect either a sideways movement or a bearish move towards the 27995 area and then a breakout below this area, which could set the index into a bearish trend. As of now, all we can say is that it's the result of the collapse of the AI firms, or the value of the AI firms, and the recently induced strength in the US dollar that has led to this drop in the index. The chart on our screen is that of ES, the S&P 500 based ETF, and we're looking at the daily chart. The S&P 500 hasn't been as weak as the Nasdaq and has been just printing dojis after dojis for the entire week, but the fall on Friday as well wasn't out of the range. So the only trade that one can expect on the ES would be on the lower time frames, like the 60-minute or the 240-minute charts, where one can take the sideways trend and go back up and down along with the movement in the range bound trade. The best place would be to take a long at around 73800 and then again go short around 7625. So that's the range that we're looking at. Do not get confused and do not take any trades on areas that have been already been retested for 3 to 4 times. As we can see this area at 7470, that most of the buy orders in this area could have been exhausted by now, or maybe could be exhausted in its next move. So it's best that we wait and try to get into a trade on a fresh zone on the low time chart and then do the sideways trend. The chart on our screen is that of Nifty, the Indian National Stock Exchange Index, and we're looking at the daily chart. Nifty as of now is poised at a very important level, and that's one of the reasons why we're visiting this chart this week. The area around 24600 has been tested by the index 3 times, and we go in for a fourth retest of this area, and there is a very strong possibility that the strength injected into the rupee by the government of India's intervention could allow the index to break above this area, and if it breaks above and closes here, then there is a chance for the bulls to make a nice profit all the way up to 25500. So that's the area that we're looking at if it breaks above this area, but otherwise it has been reeling under the effect of a weak rupee, a strengthened dollar, a devalued AI market, and also the tech companies listed on the exchange, which have been listed on the American bosses as well, have seen a lot of drop in the recent times because of the government policies and the strength of the dollar. So a combined effect of different factors has brought this index down, but it has managed to gather some of its loss, to get back some of its losses, gather some strength, and is now kind of range bound between 23800 and 24600. So that's the range that it has been following, and we could expect a breakout in either direction, but there is a greater possibility of it moving above the resistance area at 24600, and if it does that, then we're looking at a very nice bullish move towards 25500 area, where it can counter some sell orders that have been stacked sometime in February of this year. The chart on our screen is that of XAU/USD, and it is the gold based ETF. We're looking at the daily chart, Gold continues to remain bearish, printing lower highs after lower highs, and the downtrend is currently facing a lot of obstacle at 4,000. It's trying to break below this demand zone, which has been there for a while, between 3881 and 3985. So that's the demand zone that it needs to take out before going down further. And if it manages to go back down, then the next demand zone is between 3876 and 3709. Once again, since it has been in a very strong downtrend, we still would recommend that we wait for the bounce of these demand zones and come back into one of our stronger supply zones. As we can see, the current supply zone that we've talked about is not a fresh one. It was a retest of the same area on an earlier occasion, that was on the 7th of July. That's when this zone was formed. So now there are lesser number of sell orders left here, and there could be a chance of the rally breaking out of this one and going all the way up to 48300. However, in order to go long, we need to wait for a nice demand zone with a good rally or an explosive rally out of the zone, so that we know that the bears have been taken out of the market for a while. But as long the US dollar remains strong and oil continues to rise, this particular situation may not be possible, and we should continue to keep showing the rallies into our supply zones. The chart on our screen is that of XAG/USD, the silver-based ETF, and we're looking at the daily chart. Silver, after printing its all-time high at 121.73 in the month of January, came back down once the war between Iran and US was set off, and it managed to bounce off at a 64.1, and then it got restricted at 96.2. Since then, it has managed to print lower highs after lower highs, although it tried to go back up after touching 60.6 and then getting held back at about 87.76. So the recent, or the most recent high that it has touched is at 86, and one needs to see if it finds a nice sweet spot to bounce back from. As of now, we can see that it is touching upon a nice demand area between 53.6 and 45.2. That's a nice strong zone, and there could be a lot of buy orders left behind in the month of December last year. So one needs to wait and see that it bounces back up and with a nice explosive rally before you decide to go long. Otherwise, our best trade is to show the small time rallies, which could be done as of now between 61.7 and 63.5. So that's the supply zone that we're looking at if we want to go short on the metal.
Having talked about the different charts and the different asset classes and the events that occurred this week, we now come to our discussion on the option strategy for the week. The option strategy that we're going to talk about today is the broken wing butterfly spread strategy. We can also call it the asymmetric butterfly spread strategy because of the nature of the distribution of the long strike prices as compared to the shorts in the center.
In case of the regular bowfly, we have the long strike prices equidistant from the center. But in case of the broken wing bowfly spreads, we have the OTM strike price at quite a distance or widely stretched in order to give us a credit which is higher than or equal to the debit that we place after getting into a long below the short strike price, and that is an ITM and is closer to the center. So is the credit from the credit spread that is financing the debit spread in this strategy. To be very clear, we are going with a credit into this trade and we are not fully dependent upon the credit received at the beginning of the trade. What we do is we expect the strategy to be neutral to slightly bullish, and we also look at the IV which is a little high at the time of entry, and then we expect the implied volatility to contract during the life of the trade so that there is no violent movement or a price swing on the underlying during the life of the trade. In case of a call option, we expect the underlying to stay below the short strike price, allowing the long OTM and the two shorts to expire worthless and giving us a bit of profit on the long ITM that we entered. And in case of the put broken wing strategy, what we do is we look at the underlying to stay above the short strike prices so that the ITM once again gives us a bit of profit and the two shorts as well as the OTM short under the ATM expire worthless. So in both the cases, we are dependent upon the credit that we receive by entering into the trade with a credit higher than the debit, and the second profit comes from the long that we had entered, which gives us a bit of profit, but we do not want it to cross the short strikes whereby we start losing money on the shorts that we go into to credit the strategy. Therefore, the trader or the investor needs to have a very good idea, a good knowledge, and should always be aware of what's happening during the life of the trade. The first thing that he needs to look at is the strike price. The selection of strike prices is very important from the viewpoint of keeping the debit to the lowest and getting the credit to the highest. The second one is the implied volatility, which must remain under control or contract during the life of the trade. The third one is time decay, that's always in favor of the shorts and against the longs. And what we need is that all three of the options which are above the ITM should expire worthless for our maximum profit. Therefore, time is decay is working against us in this particular strategy. Finally, the direction, we want the underlying to move in our intended direction. So basically upwards in case of a call option that we buy and downwards in case of a put option that we buy. But we do not want it to cross the short strike prices that we have entered into because of the reason that we're buying too short options and we start losing money as soon as the underlying crosses the short strike price. Thus, it's a very good strategy for moderate to slightly more volatile markets, but we need to be very certain about the selection of strike prices, which must be in line with our demand and supply zones as per the intended trade, and the implied volatility has to be monitored while remaining in the trade. We can try to close the longs as soon as we see the trade going into a loss, and we want to control our losses as far as practicable. So please keep an eye on the trade till the time that all the four positions have been closed. Ladies and gents, traders and investors, we now come to the end of our video presentation, and we hope that our discussion on the option strategy was informative and exciting enough for you to get a good knowledge and utilize the information and knowledge to get into these kind of trades that work very well in moderate to slightly volatile markets. We shall revisit this option strategy because it's a complex strategy and it needs a lot of patience and a good amount of knowledge on the strike prices, the implied volatility, direction, and the role of time decay on different conditions and on the different underlying assets. We hope that you've been enjoying all our videos so far and would like to come back and watch them whenever you get a chance. If you've been liking all our videos, please hit the bell icon underneath and subscribe to our channel Polo Vega. You may also visit us at our website www.polovega.com or get in touch with us through our Twitter handle @Polo Vega. We wish you all the very best for the forthcoming week and we thank you for watching our video. Please like, share and subscribe to our channel Polo Vega.